nearly 900 jobs in France by year 2020, while Commerzbank is in the news again. What are being discussed about these two lenders in the press and on the floor by traders?
Yeah, no good news for employees and also customers of Societe Generale. 900 affiliates at least are going to be closed. They want to spend at least 1.1 billion less of money, and also they are considering to sell some other of their branches and some of their other affiliates. So this is going to be a really interesting development, also how this is going to affect share prices of the bank. Looking over to Commerzbank, we have seen Commerzbank already in the last days and weeks with a very strong share price. That's because Commerzbank has really noticed how attractive it is for other banks. Right now, the Italian bank UniCredit is again saying that they would be interested to merge or even take over Commerzbank. We have seen similar offers already in the past, also from BNP Paribas, the bank from France. And analysts are even telling me that a possible merger with Deutsche Bank could happen. We remember that during the financial crisis, the German government was buying a huge portion of Deutsche Bank in order to make sure that they would not run into complete bankruptcy. Now the German government is saying that Deutsche Bank is again stable enough to be on the own, so the government is very interested that those big portions of Deutsche Bank would be taken over by another bank. So yeah, very interesting development, Jimmy.
Right, Daniel. Well, I'll let you now go continue with your Christmas fun, but remember to come back to the market tomorrow. Enjoy the rest of the day. In the U.S., stock index futures pointed to a slightly higher open. A slew of data releases are set to keep investors on their feet. First off, advanced economic indicators are due out at 8:30 a.m. Eastern Time, followed by S&P Case-Shiller Home Price Indices and Federal Housing Finance Agency House Price Index data at 9 a.m. Eastern Time. At 10 a.m. Eastern Time, consumer confidence and the Richmond Fed Survey of Manufacturing Activity are due out, which will then be followed by the Dallas Fed's Texas Services Sector Outlook Survey at 10:30 a.m. Eastern Time. Looking to the U.S. Central Bank, two speeches by the U.S. Federal Reserve are set to take place. New York Fed President William Dudley is expected to be in New York at the third annual conference on evolving structure of the U.S. Treasury market. And Philadelphia Fed President Patrick Harker is set to appear at the Philadelphia Fed Conference on elderly financial health. The Senate is due to vote on a bill aimed at reforming the U.S. tax code. That's on Thursday. Investors have been eagerly awaiting tax reform since the election in 2016, yet doubts over whether the Republican-led Congress could achieve this before the year is out continues to weigh on the sentiment. Move on now to Asia, where major indices closed mixed today following a narrowly mixed close on Wall Street overnight. With little data due during the session, markets turned their attention to events later this week. Japan's Nikkei 225 closed 0.04% below the flat line at 22,486.24 after a choppy session. Defense-related plays, meanwhile, closed higher following headlines that Japan had noticed radio signals that North Korea could be making preparations for a ballistic missile launch. Across the Korean Strait, the Kospi rose 0.25% to close at 2,514.19, despite some tech stocks extending Monday's declines. The Australian ASX 200 finished off 0.02% at 5,984.25, at a 1.33% fall in the telecommunications sector weighed on the index. Hong Kong's Hang Seng Index came under slight pressure, trading 0.31% lower. Mainland markets, meanwhile, bounced back after coming under pressure in the past few sessions. The Shanghai Composite finished the session on 0.34% higher. The Shenzhen Composite rose 1.35%, breaking a three-day losing streak. Back here in Africa, Kenya's government is seeking proposals from banks about a possible $2 billion Eurobond offering in the first quarter of 2018. The East African nation's treasury asked banks for pitches on how to structure the sale. The deadline for proposals is November 29. Kenya's return to international capital markets will mark its first sale of foreign debt since the debut Eurobond in 2014. The Treasury is seeking to plug a budget deficit that's forecast to narrow to 6.4% of gross domestic product in the fiscal year through June from 8.5% last year. The government plans to re-enter the Eurobond market before the end of the current budget year, though a placement is likely from February onward as funds are required for spending purposes. And Sudan will take new measures to unify the exchange rates of its pound currency by next January as the country grapples with a stubborn black market and a dwindling supply of dollars in the official banking system. The central bank governor did not say what the measures will be, but ruled out the possibility that the country would float the currency. The Sudanese pound has been weakening against the dollar since Washington lifted 20-year-old economic sanctions last month, encouraging traders to step up imports and putting pressure on scarce hard currency. The central bank holds the official exchange rate at £6.7 to the dollar, but businesses are unable to secure their hard currency needs at this rate and are forced to restore to a parallel market. And the total value of capital imported into Nigeria more than doubled in the third quarter to $4.15 billion. That's after the economy emerged from a recession. Nigeria's economy grew in the third quarter, climbing out of its first recession in 25 years as oil revenues rose. Last year, the central bank imposed currency controls to prevent a collapse in the naira, which affected foreign capital inflows. Data from the National Bureau of Statistics shows capital imports were over $4 billion in the third quarter, the first such quarterly rise since 2015, just before the economy tipped into a recession. The report shows the rise was driven by portfolio and other investments. Capital imports fell to $5.12 billion last year after reaching $9.64 billion in 2005. We'll take a quick break. When we come back, we look at global oil market as OPEC prepares to meet. To stay with us.